Welcome to today's video, where we're diving into one of the most important concepts in finance: compounding. You've probably heard the word compounding tossed around in personal finance articles, or you might know that Warren Buffett, one of the world's richest people, credits a great deal of his wealth to it. But what exactly is compounding? Why does Buffett sing its praises? And most importantly, how can you harness it to grow your own wealth? Stay with me as we break down the principles behind compounding, uncover how Warren Buffett used it to achieve staggering success, and explore practical steps for you to begin applying the same powerful concept in your financial life. Whether you're a seasoned investor or you're just starting out, there's something here for everyone. So, let's dive in. Compounding, at its core, is the process by which returns on an investment generate additional returns over time. If you let your interest, dividends, or capital gains stay in your investment rather than pulling them out, your money can start to grow exponentially rather than linearly. Imagine rolling a small snowball down a snowy slope. At first, the snowball is tiny, so it only adds a little bit of extra snow. But as it grows, it picks up more snow, growing faster and faster. That's what happens when you reinvest your investment gains. Your original principal plus all accumulated gains now work together to create more returns. For instance, if you invest $1,000 at a 10% annual return, you'd have $1,100 after the first year. If you leave that $100 of profit in your investment, then your second year's return applies to $1,100 instead of just $1,000. That means a larger amount is now generating growth. Over time, this repeated reinvestment leads to results that can appear nothing short of magical. Warren Buffett, often called the Oracle of Omaha, is famous for his immense wealth. But it didn't happen by accident or sheer luck. One of the key elements in Buffett's story is that he started investing at a very young age. It's said he filed his first tax return at age 14, detailing earnings from delivering newspapers. He was so captivated by the idea of money growing through business ownership that he saved and invested at every possible opportunity. While Buffett is undeniably skilled at evaluating businesses, he also possessed another invaluable asset: time. When you begin investing in your teens or early 20s, even modest returns have decades to gather momentum and produce exponential results. Buffett's fortune today is largely a testament to letting his early investments compound for over half a century. One of the most surprising facts is that a huge portion of Buffett's net worth came after he turned 50. That's the snowball effect in action. When you have decades of continuously reinvested gains behind you, each new leap in the market has an outsized effect on your overall wealth. Buffett has often remarked that his strategy is straightforward. Find great businesses at undervalued prices, hold them for the long haul, and allow compound interest to do the heavy lifting. To understand how Buffett made compounding work so effectively, we need a glimpse into how he invests. While having decades on your side is crucial, you also have to invest in a way that produces steady returns. Buffett learned value investing from Benjamin Graham, who taught him to look for undervalued companies with strong fundamentals. Buying shares at a discount means you have a margin of safety. Over time, as markets correct mispricings, these companies' share prices rise, enhancing compounding. Buffett often says his favorite holding period is forever. Instead of jumping in and out of trades, he buys businesses he understands and trusts. This patient approach means he's less impacted by daily market fluctuations and more tuned into the company's long-term potential. Many of the businesses under Berkshire Hathaway either pay dividends that can be reinvested, or they simply retain profits to expand operations. This reinvestment accelerates growth at the company level, translating into higher overall returns for shareholders. Compounding is most impressive when given plenty of time. Imagine two people. Person A starts investing $500 a month at age 25. Person B starts investing $500 a month at age 35 with the same average return. By the time each person reaches age 65, Person A will have contributed just 10 more years' worth of $500 monthly investments. Yet, those extra 10 years of compounding could result in a significantly larger portfolio, sometimes by hundreds of thousands of dollars. The earlier start makes a dramatic difference precisely because of the way returns stack over time. Warren Buffett's accumulation of wealth shows this principle. He began extremely young, so his capital had years, turning into decades, to build upon itself. There's no secret formula to a long investing horizon other than discipline. Start early, keep contributing, and reinvest what you earn. One of the greatest obstacles to successful compounding isn't the math or finding decent investments. It's human emotion. Markets don't move in a straight line. They rise, fall, surge, and crash. When a market downturn hits, many people's instinct is to sell and save what they can. However, doing so can interrupt the compounding process. Buffett himself has famously said that the stock market transfers money from the impatient to the patient. Those who sell during a panic lock in losses and miss the inevitable rebound. By contrast, patient investors often buy more shares at lower prices, setting themselves up for even greater gains when the market recovers. Compounding works best when you allow it to run its course, even through bear markets. Historically, the broader market has always recovered and moved higher over the long term, rewarding those who held on. Thus, the biggest psychological challenge is discipline, ignoring short-term noise in favor of long-term growth. While Warren Buffett is the quintessential example, he's certainly not the only wealthy individual who has leveraged compounding. Amazon started in a garage selling books. Over time, Amazon reinvested its profits to develop new services like Amazon Web Services, AWS. By continuously channeling returns into new ventures, the company's value soared exponentially, making Bezos one of the world's richest people.
You can choose a life of ease and comfort, or you can choose a life of service and adventure. Which one of those, when you're 90 years old, are you going to be more proud of?
Microsoft's success was boosted by the reinvestment of profits into research, development, and acquisitions. This approach steadily built Microsoft's market share over decades. Gates's wealth multiplied along with the company's share price. In the late 19th century, Rockefeller's Standard Oil reinvested profits to control more of the supply chain, fueling significant expansion. Over time, this reinvestment model allowed Rockefeller to amass what would be considered billions in today's dollars. Compounding isn't just for billionaires or financial wizards. The magic of growth on growth is open to anyone with a bit of discipline. Here are some actionable steps to set yourself on a compounding trajectory. Open an investment account. If you don't already have a brokerage account, consider opening one with a reputable firm. Many platforms have no account minimums and offer user-friendly apps, making it easy to get started. Automate regular contributions. Decide on a fixed amount you can contribute each month, then automate that process. This removes the chance of forgetting or getting cold feet during a market dip. Reinvest dividends. If you invest in dividend-paying stocks or mutual funds, make sure you reinvest those dividends. This is one of the simplest ways to supercharge compounding without having to do anything extra. Diversify. Warren Buffett may hold large positions in a handful of companies, but for most new investors, diversification helps mitigate risk. Consider index funds or ETFs if you're unsure about picking individual stocks. Remain patient. Time is your best ally. Resist the urge to frequently check your balance and panic at dips. Instead, review periodically to ensure your allocations are still aligned with your goals. Educate yourself. The more you understand investing concepts like valuation, risk management, and market cycles, the more confidently you can stay invested long-term. Even if you begin with a small amount, the key is consistency. Remember, Buffett's empire didn't start with billions. It started with small sums, carefully invested, and allowed to grow for decades. In Buffett's youth, investing required more manual effort. But today, technology has made the compounding process more accessible than ever. Robo-advisors, platforms like Betterment, Wealthfront, or SoFi automatically allocate your money into diversified portfolios. They also handle rebalancing, which can keep your investments on track for steady growth. Fractional shares. You can now buy partial shares of high-priced stocks, meaning you don't need thousands of dollars to invest in industry giants like Amazon or Tesla. Low or zero commissions. In the past, trading fees could chip away at smaller accounts. Today, many brokerages offer zero commission trades, which helps your money go farther. These tools remove traditional barriers and let newcomers harness compounding with minimal friction. Even $50 a month, continuously invested, can become a significant nest egg given enough time. Compounding isn't solely the domain of celebrity billionaires. Ordinary people have quietly built substantial wealth through consistent, long-term investing. Two well-known examples include Ronald Read. Ronald was a janitor and gas station attendant in Vermont. He lived frugally and invested systematically in stable, dividend-paying stocks. When he passed away at age 92, his estate was worth over $8 million, stunning everyone who knew him. Grace Groner. Grace was a secretary who, in 1935, bought just 3 shares of Abbott Laboratories stock for $60. Through decades of stock splits and reinvested dividends, her position grew to more than $7 million by the time of her passing at age 100. Their stories prove that you don't need a huge salary or special connections to benefit from compounding. If you keep adding to your investments and reinvesting gains, time can amplify even modest sums into real wealth. Perhaps the most crucial element in successfully harnessing compounding is adopting a long-term mindset. Warren Buffett often remarks that he doesn't worry about day-to-day market gyrations because he invests with a time horizon of decades. That same patience is what allows compounding to unfold at its fullest potential. Accept volatility. Recognize that market fluctuations are normal. Over 10, 20, or 30 years, the general trend for well-selected assets is upward. Regular contributions. Make investing a habit. Consistent contributions harness compounding in both good times and bad. Celebrate progress. You might not see exponential growth in a single year, but after a decade, you'll likely notice a dramatic difference in your balance. Stay educated. Understanding how businesses operate and how markets behave can boost your confidence. Knowledge is a powerful antidote to fear. By focusing on the long game, you position yourself to capture the full magic of compounding and avoid many of the mistakes that hamper short-sighted investors.